good morning, good afternoon, and good evening, wherever you're joining us from. A very warm welcome to our webinar today, Seeing the Risk, Using Climate Risk Analytics for CDRFI Decision Making. My name is Monica Odhiambo, and I'm an advisor with the Global Shield Secretariat. It is really my pleasure to be your moderator today, and I am joined by my colleagues, Andrea, May, and Mokau. I think you can wave at the put your videos on and wave so that you can be seen. They'll be supporting today's webinar by managing the chat, technical arrangements, and also the Q&A. So we are very, very delighted by the response to this session that we have seen. We got over 300 participants registered from close to 70 countries, and this is really impressive, with more than half joining us from Global Shield partner countries. So this is really a strong response and reflects the growing interest in understanding how climate risk analytics can really support better CDRFI decision making. Maybe we can move on to the next slide. Yes, and so before we begin, we always have to just keep the house rules. Just a few practical points before we start. Please remember to keep your microphone muted if you're not speaking. And then please post your questions in the chat throughout the webinar. We'll collect them as we go and also address as many as possible during the Q&A session. And also the live captions are available. May will put the instructions on how you can access this into the chat. And we are also glad to let you know that we have the French interpretation available today as well. And so before we begin, I'd like to let you know that this session is being recorded. I think you'd have already seen a pop-up in your Teams letting you know that the session is being recorded. And so the recording and the slides will be shared with you afterwards and also published on the Global Shield YouTube channel so that you can access them. Next slide, please. And just to give you a quick word on how the next 90 minutes will run. We have 3 perspectives for you on this topic. And so we'll give you the technical perspective. We'll also look at 2 country perspectives, and we also have the practitioner's perspective. And at the end of it, we'll give you an opportunity to ask your questions and also to discuss. And I hope you have as many questions as possible. We'll do our best to answer those questions. Next slide, please. So this is the first of our 4 webinar series in the Global Shield webinar series journey. So we want to follow the CDRFI journey. Today, we start with where every financial protection strategy has to start from. So with understanding the risk. And then after this, in September, we turn to designing solutions and instruments. And then in December and March, we look at how we can make these solutions and instruments inclusive. So we hope you can follow us in this journey. So today's session is also a complementary to the Global Shield Foundational Learning. These are the self-paced courses that you find on our website. So I know some of you have taken them. So if you've taken this, the Foundational Learning course, today's webinar is just an opportunity for you to see those concepts applied in practice. And if you're new, we hope that it provides a valuable introduction and it encourages you to explore the course afterwards. And so to open for us formally, it is my pleasure to hand it over to Katia Goetz. Katia is the Deputy Director of the Global Shield Secretariat. Katia, over to you.
Thank you very much, Monica, and good morning, everybody. And thank you for joining us for this very first webinar. It's my great pleasure to welcome you to this webinar. And for this webinar, we have really deliberately chosen to begin here with risk, because understanding the risk is the foundation for everything that follows. In our work across the Global Shield countries, we have seen again and again that the starting point matters. So before we can talk about solutions, financing tools, or implementation pathways, we need a shared understanding of the risks countries are facing, how those risks are changing, where the gaps in protection are, and what is already in place. Without that, even the best designed support can miss the mark. And this is why this very first conversation is so important. So this session is not simply only a technical introduction. It is the groundwork for the rest of the series. So it really gives us a common language. We need to understand why some countries are more exposed than others, why some systems are better suited to absorb shocks, and why prearranged finance must be designed around country realities rather than assumptions. And throughout our work, we have really learned that risk is not an abstract concept. It is shaped by institutions, public finance systems, climate exposure, market structures, and social vulnerabilities. It is hence also deeply local. This means that the conversation about risk has to be grounded in country context, led by country priorities, and informed by the people and institutions who live with these risks every day. We have also learned that when countries take the time to understand their risk landscape properly, they are much better placed to identify meaningful solutions that can cultivate robust financial ecosystems. They can see where the biggest protection gaps are, what kind of support is needed, and how different actors can work together more effectively. In that sense, risk analysis is not the end of the process. It is what actually makes the process possible. So today's webinar is really more about more than just introducing the topic. It is about laying the intellectual and practical foundation for the series that follows. As Monica has also indicated, so this webinar is also a very good example of the growing suite of capacity support offering available from the Global Shield, from our new base at the Frankfurt School, which really helps us to expand our access to academic research, financial expertise, and capacity development resources. And for those of you who don't know, Frankfurt School is a private, not-for-profit business school based in Germany with more than 150 million revenues in 2025 and more than 560 staff. Alongside teaching and research, we offer extensive training and consultant services that really aim at connecting the academic experience with real-world practice. And the Secretariat is now also sitting alongside the Global Shield Solutions platform at the Frankfurt School, and this proximity really also helps to reduce silos, strengthen coordination, and speed up the delivery of prearranged finance in ways that are responsive to country priorities and the needs of climate vulnerable nations. So I'm very glad to open this discussion, and I look forward to the exciting exchange ahead. Thank you so much, and back to you, Monica.
Thank you very much, Katja, and thank you really for setting out both the why this matters and how as the Global Shield, we're working with countries to respond to it. And so now that you've framed the why, I would like for us to turn to the what and the how. And our first substantive session takes us into the analytics itself. And before I introduce our first speaker, I'd like to say a word about who is with us today. So we are joined by colleagues from ministries of finance, insurance supervisory authorities and regulators, international organizations, academia, the private sector, and also the civil society. And many of you also told us during registration that you're new to CDRFI and are looking to strengthen your understanding of the fundamentals. So our speakers have taken this into account today and in preparing the session and presentation. So wherever you are on this learning journey, best believe you're in the right place. So on that note, I'm pleased to introduce our first speaker, Dr. Stuart Fraser. Stuart is a climate and disaster risk consultant with the Global Risk Modeling Alliance, which is also hosted by Frankfurt School of Finance and Management. And Stuart works directly with governments to strengthen climate risk analytics and modeling capabilities. So we're in the right hands here. Stuart, the floor is yours. You have 20 minutes.
Okay, thank you, Monica and Katja, for the introduction to the series, and I'm glad we can contribute to the risk understanding piece of this series, and thank you for the invitation to speak on this today. If you can go to the next slide, I'll just quickly summarize the 4 areas I'll talk about. Those are covering very quickly some of the key concepts, approaches, and types of climate risk information that we use at the Global Risk Modeling Alliance and that we speak about regularly to improve risk understanding and lay the groundwork or lay the foundations for risk financing and insurance. And we'll talk about how the analytics is used in CDRFI in the design and the trigger of insurance products, for example. I'll also just give a quick overview of GRMA support in Global Shield partner countries. We've been working in Malawi and Madagascar and Costa Rica, for example. So I'll talk a bit about those activities, and I'll leave you with some links to some useful resources as well at the end there. So if you go straight to the next slide, that'd be great. Thank you, Monica. So yeah, the value of disaster and climate risk information has already been mentioned, but just to go into a bit more detail on how risk information can be used, it's all the way through identifying the risk, identifying how risk can be prevented and reduced, looking at the most suitable adaptation strategies, projecting risks into the future to look at how climate change is affecting those risks and how we need to invest in strategies and infrastructure that is robust 10, 20, 50 years down the line, for example, not just today. We also use analytics heavily in the design and the pricing of climate and disaster risk transfer and insurance. So I'll use the term CDRFI for that through the presentation. It's also vital in social protection, anticipatory action using early warning systems and impact-based forecasting to respond earlier to disasters, and also in shock responsive social protection. And I know the audience had a few questions around how analytics can be used in those areas. And importantly, we can use risk assessments to plan in a forward-looking manner for response and reconstruction scenarios to build back better or make our buildings, our infrastructure, our communities more resilient. So next slide, please. So risk assessment can take various forms. Commonly, we see qualitative risk assessments, narratives based on expert input, stakeholder storylines that provide a good amount of risk profiling, talking about where risks are, who they affect, what the effects are. We have an awful lot of semi-quantitative indicators. So something like the Inform Index, giving a national or a subnational view of risk in terms of low, medium, high, for example, would fall into that category. And we have quantitative risk assessment, which I'll focus on today because we really need that quantifying aspect for risk financing and insurance. And that includes scenario modeling, so the deterministic models of individual worst case events, for example, for stress testing or understanding the impacts today of some key historical events. And we have stochastic or probabilistic modeling that gives us estimates of the annual average losses or damage and estimates of loss from both frequent events but also extreme events that maybe we haven't captured in the historical record. Next slide, please. So this is a graphic of a catastrophe model. The catastrophe model includes various modules. First of all is understanding the hazard. So looking at understanding the likelihood of a flood or a cyclone occurring in a particular place, looking at the maximum intensity, so the flood depth, the wind speed, the amount of storm surge, for example, that might happen because of an event. And we look at the full range of events, as I said, the frequent and the rare events. So we can look at how a flood might happen if it's an annual flood versus something that happens maybe once in 50 years from a more extreme rainfall event. We have the exposure module, which requires us to map buildings, infrastructure, population, describe the locations and the characteristics. So for a building, we might be looking at the ground floor depth, we might be looking at the roof material or the material of the walls. And that plays into the vulnerability module, where we understand the relationship between the level of hazard and the potential damage to a certain type of building. So, for example, the same level of flood will affect an unreinforced masonry building differently to a timber building, and an earthquake will have a different effect on a one-story building to a 5-story building, for example. And that's what we try to understand and include in our models in the vulnerability section. We pull that all together in the impact module, looking at the probabilistic simulation of risk. And we run thousands and thousands of events, or tens of thousands of years of possible events, to really get a full distribution of the potential impacts of those events. And we look at the loss from every event, and we can look at the loss for a particular region of a country or set of locations. And we put those outputs through a financial module if we're looking at risk financing, to understand how those losses translate into a sovereign DRFI product, for example, and the effect of different limits and deductibles on the loss. And so looking at this another way, this is an example from Costa Rica, some data on flood and the hazard. So we create flood hazard maps for particular events and for key return periods. We map exposure. This example on the bottom left shows buildings and infrastructure, or different types of infrastructure in part of the capital, San Jose. We have a series of vulnerability curves which generally look like that. This example is for earthquake, but they look quite similar for different hazards. And then we can output an annual average loss per asset, or for a road network, or for a buildings portfolio. And we can also export graphics like the bar chart shown, which give an estimated loss for a particular return period. If you go to the next slide, please, I'll talk a little bit more about the key metrics. So I've mentioned these two already several times. We can't do risk assessments without talking about the metrics. And this slide really tries to explain what those are. So annual average loss really gives you the long-term expected cost per year. A country would experience less or more than the AAL each year, but over the long term, that's the level of loss you can expect in an average year. And that's really useful for pricing premium of risk financing and insurance, and it's useful for budgeting, setting out the amount of funds you might need in a national reserve fund, for example, to cover small losses. And we also look at the return period, which gives you the loss at a specific point, generally for extreme events. 1 in 100 year, 1 in 50 year event are typical return periods that we would communicate. And those are really useful for understanding how much capital or the impact on GDP or government financing that might occur from an extreme event. And that can sometimes be a big part of the government budget. And on that slide, there was a few references to, thank you. So 1 in 100 year event has a 1% annual probability of being exceeded in any year. But on the right-hand side, I've used a very useful tool on resilienceexplorer.com that translates that into a different probability given a political cycle, or a human lifetime, or for an asset life. So that's a very useful tool to understand return periods and their likelihood over different timescales. So I'd encourage looking at that. Next slide, please, and we can skip this one. So we use analytics to understand financial resilience, CDRFI, but I wanted to flag that that's not done in isolation. So we're looking at financial resilience, but we're also looking at social and physical resilience as well. And analytics can underpin all of these, and ideally we'd be looking at analytics that can be used consistently across the three areas, so that different solutions can be working off the same baseline of risk information, and they can all be driven by evidence and consistent data. If you go on to the next slide, please. So we use risk modeling analytics in defining risk layering strategies. I've already mentioned national reserve funds as a solution for covering the impacts of frequent events, but it becomes very difficult to hold enough capital in a reserve fund to deal with the extreme events, and that's where risk financing and insurance comes into it. And we use analytics to understand the cost efficiency of using that money for different sizes of events. We try to match different instruments to different functions, so retaining the risk or paying for frequent events out of those disaster funds, and then transferring, as I say, those more high severity, low frequency or more extreme events. And that can be through sovereign risk transfer, can be through public asset insurance, can be through business or homeowner insurance. And risk analytics can help to understand the benefits and the challenges with all of these different types of products together, so in combination. And it also allows us to understand which climate risks are insurable, which are not, and which to transfer risk. So we use risk modeling to both design specific solutions, as well as look at the most suitable combination or most beneficial combination of solutions. So it allows us to understand the limits and the attachment points of different layers in that layering strategy, and enables us to look at the different probabilities of a payout from a particular product. So government can understand how much or how frequently or what types of events they would receive payouts from, and insurers can understand how much premium to charge, how frequently they will be likely to pay out to the government. We also use analysis in the triggering of, for example, parametric solutions. So we use pre-agreed models to trigger payments, but we also use analytics to set the trigger thresholds, looking at the risk profile and understanding the hazard level that correlates with significant damage, for example, and also to try to minimize the basis risk in product. So trying to tie the potential for payout as closely to on-the-ground experience as possible, so there's not a mismatch between an event occurring and a payout occurring. And all of the analytics provides trust and evidence into designing those solutions. Specifically for insurance supervision, because I know we've got lots of supervisors on the webinar today. There's a lot on this slide. I think just the key highlight is that the IAIS, International Association of Insurance Supervisors, has published a lot of information recently on the importance of climate risk in supervision. And I just called out this quote that natural catastrophe models are necessary to address many of the principles underpinning the framework for insurance supervision. There's lots of areas of supervision that analytics and understanding of risk is really important for. And insurance supervisors are able to bring climate risk analytics and understanding into various areas of their work, from market development through strengthening risk management, disclosure of risk, examining solvency from growing climate risks, and also ensuring consumer protection and stability of the insurance sector in their countries. So going back to that first slide, the analytics can really help to understand the climate risk within the insured and uninsured portions of a market, and help to design those innovative solutions to grow that insurance cover for catastrophe events. And so hopefully that gives you a very quick overview of the application of analytics in risk financing and insurance supervision. There's lots more detail that we could go into another time. But I'd like to switch just now to demonstrate some of the support that Global Risk Modelling Alliance provides in Global Shield partner countries. So if you go to the next slide, please. This shows where we're active at the moment. So we've been completing work in Madagascar and Costa Rica recently, and we're at the beginning of a project implementation period in Ghana. We have a call for proposals out in Senegal, and we're due to start project implementation very soon in Malawi as well. So we're active in various different countries with varying levels of existing risk capability and focus on risk financing or risk management. But I'll share some of the project outputs from Costa Rica, particularly in a couple of slides. Okay, next slide. Yeah, so capability is really the core of the Global Risk Modelling Alliance. We provide a technical assistance service. I myself I'm an expert in disaster risk analytics, both in the development and the insurance sectors. We have another couple of experts with the same background, and we have climate model experts. So we provide assistance in the definition and the implementation of technical risk assessment projects. We use open platforms and open standards to develop the sustainable and accessible data and models, and everything we do is designed for public good. But capability development lies at the heart because we want to bring autonomy in understanding and managing risk to countries. We work in partnership in everything we do, from co-defining projects to co-developing the models and data. And we bring a multi-sector, private, public sector focus to this. And we really try to build on local knowledge where it's available and bring local expertise into the projects, into the data, the models, and the management of that risk understanding capability. So next slide, please. I'll just very quickly talk about Costa Rica, where we did a critical infrastructure risk assessment in one municipality, a risk assessment for a national road route. We assessed risk to small and medium hotels in the tourism sector, and we looked at flood and drought risk assessment for several key agricultural crops, coffee, sugarcane, and also livestock to inform risk transfer. So all of these projects were done in partnership with a technical working group of Costa Rican experts and relevant organizations. And the aim has been to do a risk assessment for a small portion of a sector or the country, and those organizations take on the capability to replicate that data curation or that risk assessment after the GRMA project. So if you go to the next slide, please, I'll just demonstrate this for the transport network. So we worked with the University of Costa Rica on the road transport risk assessment, and they have since maybe 6 months ago have been running their own assessment in parallel to the GRMA project for new road networks or other road networks within Costa Rica. So they are now independently running their own probabilistic risk assessment and are able to compare the risks that occur on different roads and look at different risk management strategies for different parts of the road network. And ultimately, we'll be able to have a whole road network risk assessment to look at risk financing for that public infrastructure. If you go to the next slide, please. For Malawi and Senegal, we have a variety of modelling activities and capability development. So in Malawi, we're looking at climate adaptation measures and doing adaptation modelling, macroeconomic modelling, and bringing climate shocks into an existing macroeconomic model, and demonstrating how risk estimates can apply to CDRFI decision making. In Senegal, we're focusing on expanding the availability of flash pluvial and fluvial flood. We're looking at the impact of coastal erosion and coastal inundation in certain areas of the country, and we're looking at developing a method to collect and manage post-disaster loss and damage data. So a variety of activities that we undertake in GRMA. Okay, a couple of last quick slides, I'm aware of time. Yeah, the importance of developing a risk function. I think hopefully that's become clear through the slides I've talked about, but national risk assessments really help that identification of risk, prioritizing investments and policies, and support forward-looking planning across multiple sectors with a risk-informed or data-driven foundation. And a sovereign risk function is really important to manage the understanding or maintain that understanding of risk in country, because risk is changing all of the time. And engaging an international consultant to come in every 5 years or so to do a risk assessment gives you a snapshot, but it doesn't enable you to update the view of risk as your cities are changing or as your hazard profile is changing and capturing changing conditions with the local expertise that exists in your institutions over time, every year or every couple of years. So it's important to generate that evidence and data within countries and make those informed decisions on the basis of official data and data from within your institutions with the people who are expert on the conditions, the local context and implications on the ground. So I'll leave you with the next slide. There's several resources available both on the Insurance Development Forum RMSG tools page. These are more analytics workflows. They're all open and free online tools that give you a catalogue of risk models or parametric solution catalogue and case studies on parametric solutions for different sectors or types of coverage. We have step-by-step guides to parametric insurance, for example, and using data to design parametric. And then on the grma.global capability development webpage, we have a bigger library of principles, reports that provide glossaries or context and concepts and principles around risk analytics and also disaster risk financing. So hopefully those resources can help as you go through these webinars to expand some background information on analytics in particular. Okay, so I can finish there, and we've just got a slide of GRMA partners and the support from IDF member companies and our collaboration with Frankfurt School, who manage the GRMA program through KfW funding. Thank you very much. So I'll leave that there, but I think there's time for questions later.
Yeah, thank you, Stuart. I don't know how we are doing on time, Mokau, but maybe we'd have quick reactions from you on the 2 questions in the chat. And I know Abu, the third question, maybe we would respond to it later. Stuart, if you could respond to Ifan. He's asking, can you explain NatCat models 1 and 2 concept of return periods? Yeah, maybe we can start with that.
Yeah, I mean, that's I've tried to go over this very, very quickly. I mean, the slide 6 with the graphics of the hazard exposure vulnerability and risk component is really the concept of the NatCat models. So I don't know if these slides, I know that the webinar's recorded and the slides will be shared, right? But that's a summary of a NatCat model. I can post some other resources with more details on what that is, maybe in the chat through the rest of the session. And the concept of return periods, I really tried to summarize that on slide 8. I think it would take too much time to go into the real details of that, but maybe I can pull up a resource again to drop into the chat. On the concept of layers for risk assessment, really the risk layering was for risk financing, and the assessment allows us to define those risk layers. The layers, if you go to slide 11, this one, the risk layering is really the next slide, sorry. Risk layering really provides a strategy to manage different levels of risk using different solutions. So as I mentioned, so we have very frequent events that are happening every year or multiple times a year, and the impacts tend to be small on the scale of disaster events as a whole. They might be very big, they might have very big impacts locally, but on the scale of what could be possible, they tend to be the smallest events. And those are more more manageable with local funds by retaining the risk, so the government can keep enough funds in their budget to pay for those small events. So that's the layer that is disaster funds. Then you have more expensive events that become too expensive for the government to cover just themselves by their in their National Reserve Fund, for example. So you start to introduce other sources of financing to help the government pay for the response and the reconstruction of those events, so that the government's not having to take funding from the education budget or the health budget and move money from other areas. And as you go up to the more extreme events, you can transfer that risk to the international markets. And it costs money. It costs a premium, for example, but that premium is much smaller than the overall cost of an extreme event that could take many tens of % of the national GDP in one event, and could require a government to move lots of money from different parts of the budget. So it becomes more efficient to pay for a small premium every year and get a bigger payout in case those extreme events occur. Again, I'll try to share a risk layering kind of concept resource in the chat as we go through the event as well.
Yeah.
Thanks.
Great. Thank you, Stuart. I think it will be great for you to share those resources for further reference for the participants. But I know we have questions coming in, but allow me to stop the questions now here. We will pick them up later in the Q&A session or as we proceed with the presentations where relevant. But in the meantime, I think Stuart has really given us the vocabulary, and I also believe the building blocks for everything that follows on. And I know, Stuart, you really emphasized on capability development. And now we want to see from our next speaker what happens when countries actually begin to build those capabilities in practice. And so allow me to introduce Madam Bako Nirina Rabevohitra. She's the Deputy Executive Secretary of the CPGU in Madagascar. This is the Disaster Agency of Madagascar. And Madam Nirina will share Madagascar's experience of strengthening climate risk analytics and what the country has learned so far along the way. Welcome, Madam Nirina.
Thank you very much, Monica, for giving me the floor. And first of all, I would like to thank Global Shield for inviting Madagascar and for inviting me to take part in this very first Global Shield webinar. I am really delighted to have the opportunity to share the experience of Madagascar about climate risk analytics and CDRFI. Next slide, please, Monica. Well, Madagascar has implemented the phase 1 of GRMA from 2024 to 2026. And during this phase 1, we could develop and update a national risk profile while taking a multi-hazard approach into account. The available risk profile will only focus on tropical cyclone, flood, and earthquake, but we could extend the model to other hazards that mainly cause vulnerability in the country, such as drought, landslide, sandstorm, locust invasion, and coastal erosion. During phase 1, the national technicians could also benefit from capacity buildings, and a standardized database on risk has been set up on GeoNodes. And then a data collection on exposure has been carried out in Murndav as a pilot phase, and it is to be continued in the next phases. Next slide, please. So we can say that such achievements are very important in the field of disaster risk management in Madagascar for 3 reasons. First, because they strengthen risk knowledge and risk understanding, as it is recommended in the Sendai framework and in our national strategy on disaster risk financing. Secondly, these achievements also provide decision support tools, for example, to guide risk reduction planning, for example. And then those achievements also allowed us to build resilience through tools that help us to reduce human and economic losses. Next slide, please, Monica. Now, talking about challenges and lessons learned, at this stage, the national technicians gradually assimilate the models and methodology, and they will try to improve and update gradually the data and the risk profile according to the availability of data from the field. The collection on exposure should be extended in order to obtain a model that is closer to reality. Then it is also necessary to develop tools that are more accessible to decision makers. And also it is important to strengthen the data sharing mechanisms to better coordinate. And then one of the success factors is the coordination and implication of relevant sectors and ministries, technical institutions, partners, and all the stakeholders during the process. At this stage, we are about to implement the phase 2 of GRMA in Madagascar, and it is planned during this phase 2 to model flood risk associated with heavy rainfall caused by tropical cyclones. It is as well planned to estimate the impact of climate shocks on internal displacement and also to model the macroeconomic impacts of climate shocks. Through all of these planned activities, our collaboration with GRMA is really helpful to strengthen and improve risk knowledge and risk understanding through scientific methodology, universal methodology, and also through skill transfer. Next slide, please, Monica. Finally, I would like to briefly discuss the CDRFI and ARC insurance schemes in Madagascar, which are considered as really relevant to addressing the country's needs in the face of climate change. First, there is a complementarity between GRMA model and ARC model. There is also a complementarity between the sovereign ARC insurance and ARC replica insurance, and such a complementarity allows to promote financial resilience in Madagascar. But to talk particularly about the sovereign insurance, the rate of risk transfer is still low for the 3 ARC products. For example, it is less than 1% for the tropical cyclone, less than 7% for drought, and less than 15% for flood. So the government is demonstrating a strong commitment through its contribution to the payment of the premium, even if the budgetary constraints prevail. In Madagascar, the sovereign insurance plays a critical role in supporting rapid response and also recovery in case of devastating cyclone. ARC insurance is quite the unique mechanism that can support recovery and reconstruction. We can say that it brings concrete changes and transformations at the local level after a cyclone. And with this in mind, we can say that the mechanism, ARC mechanism, provides an opportunity to transform disasters into opportunities for sustainable development at the local level through the application of the Building Back Better principle. As we see in these pictures, these infrastructures shown are some illustration of the transformations at the local level that are lasting solutions for disaster risk management in highly exposed areas. Well, talking about ARC insurance, the government is making significant efforts to honor its commitment, but we cannot yet do without the support of partners. So please allow me to make this plea. Support from partners is really, really essential to ensure the long-term viability of ARC insurance mechanism and also to expand the insurance coverage in order to reach more beneficiaries as much as possible, given the scale of needs in the event of major hazard. Madagascar is among the most vulnerable countries to climate change in the world, so it really needs to build its resilience. ARC insurance is a vital humanitarian instrument that helps to save lives, to reduce vulnerability, and to promote recovery. So Madagascar is extremely grateful for any support regarding CDRFI and particularly ARC insurance from partners and donors. During my intervention, I would like to reiterate our thanks, our grateful for the support of GRMA in the field of risk understanding and risk modeling. And we are also really grateful to Global Shield for the support of Global Shield in the field of risk financing and CDRFI. So this brings me to the end of my presentation. Thank you very much for your attention. Thanks again to Global Shield. And now I welcome any questions or comments you may have. Thank you very much.
Thank you very much, Madame Nerina. That was really great to hear your experience in Madagascar, and also just to hear the importance of partnership. And it's not just technical capability, but also coming in to support the different financial instruments that exist or that actually provide the solutions for the country. And maybe I would just ask you one question before we move. You've just shared the experience of Madagascar. For a new country that is just beginning this journey, what is the one piece of advice that you would give to them? A brand new country that is just starting to think about climate risk analytics and CDRFI.
Yes, thank you for your question, Monica. I think it is really important to involve all relevant sectors so that they have ownership of the process of risk analysis and CDRFI process. It is also very important to leverage the data already available at the sector level and continuously update the risk model using data collected from the field. We think that this approach really strengthens the model's accuracy, ensures that the model reflects current conditions and support evidence-based decision making. Thank you.
Thank you so much. I hope that intervention is helpful for some of the countries here, Global Shield partner countries, as well as those who are just starting the journey on climate risk analytics. And maybe before we jump into the next session, I would just like to ask Stuart to react to this question, and also maybe Madame Nerine, because you've also worked with Global GRMA, and you've also engaged different stakeholders, maybe clarifying the question by Paul, clarify on the roles of different actors and stakeholders in a country who would be doing which steps of the analysis, assuming the policymakers or decision makers themselves would not be the ones carrying out the in-depth analysis. So Stuart, maybe you can come in, and then Madame Nerina can give Madagascar's example here. Great.
Yeah, I mean, in general, in a country, we meet stakeholders who are already in charge of parts of the data or the risk understanding system. So the Hydrometeorological Agency already have the mandate to manage observation networks and issue early warnings and understand and communicate the climate data to the government or public. Statistics Agency already manage census data, or the public works will have asset inventories of infrastructure or public buildings, for example. So what we would try to do in GRMA is to bring those organizations together to understand how the distinct pieces of information that they hold can be used to understand risk. We need all of those parts of information, and sometimes in countries the appreciation that piece of information is really important for understanding risk is maybe lacking. And I think what we try to do in GRMA is bring all of those agencies together, and people realize they have similar risk questions and they have data that is useful to answer those questions. Who would then do the risk analysis is something we discuss during GRMA programs. Sometimes the Hydromet agency may take on flood risk assessment. In Costa Rica, it was the University of Costa Rica, specifically an engineering department, who were already involved or responsible for understanding and communicating the condition of the road network, who have taken on that risk analysis. But that sustainability of who manages different components of data and who takes on the risk assessment is something that we have lots of conversations around to make sure the process is sustainable. But it's something that the government has to define for their own country in terms of their local structures and governance, for example. Hopefully that answers some of the questions. In the bigger insurance framework, then there are other actors as well that come into that too.
Yeah, thank you, Stu. I think that covers quite a bit of it, but if Madame Nirine, you have any input there on how Madagascar has worked with the different stakeholders, I think that would be important for the participants to hear. Yeah, if not, it's okay, we can move on to the next.
Yeah. Yes. Yes, thank you, Monica. Maybe I would like to share very briefly the implication of relevant sectors in Madagascar, because there are several stakeholders and actors in the field of disaster risk management and disaster risk financing in Madagascar. And also the ministry departments are also concerned, involved in the process. So we have involved them so that we can leverage any available data from each sector, from each actor. And the aim also with the GRMA process is to better coordinate. That is why we intended to set up this unique database on disaster risk management to better coordinate, and also to let every sector to have a common tool through the new updated risk profile, new tools based with universal and scientific methodology to better enhance and improve the risk understanding at the level of each actor, so that we can better manage our risks. So the main idea is to leverage every data available, and also to share experience also, and to learn from each others also. Thank you.
Great. Thank you so much, Madame Nirine. Thank you, Stuart. I know we have more questions in the chat, but we will come back to this at the end. So just do keep posting your questions in the chat. For now, I think we've had why climate and risk analytics matters and what it takes abilities at the country level. So our next speaker will take us one step further, and there's already a question on parametric, and we had a lot of discussion on Africa risk capacity and also intervention from Madame Nirine on Africa risk capacity. So it will be very great to now have the perspective of the practitioner who is actually Africa risk capacity. And I'm very delighted to welcome Jacqueline Mudengi, who's the head of underwriting and innovation at ARC Limited. So Jacqueline sits precisely where today's question gets answered in practice. So she'll take us the risk information and turn it into instruments that pay out when countries need them. And Jacqueline, as you've heard, ARC has been named directly and repeatedly, even in our registration responses. And so just know you have an expectant audience. And over to you. You have 15 minutes.
Thank you. I think I need a whole day, but I'll do the 15 minutes. So let's move on. So in the next 15 minutes, I'll be walking you through the journey of how we convert risk information to financial protection. So I'll not complicate it. I'll make it 3 steps. If you can remember, that would be great. Please move on to the next slide. So we have been mentioned in a couple of slides and questions, and what I can say and testify is that ARC Limited is is a testament of what climate risk analytics and the power of climate risk analytics when it comes to CDRFI. So we use climate risk analytics to transform into financial solutions across different levels, at individual level, which is micro, at meso level, which is aggregator level, and at macro level, which is governments like Madagascar and Malawi that we'll be speaking later. And using climate risk analytics, we design different types of products, ranging from drought all the way to epidemics. And given that the core function or the core principle of CDRFI is fast response, prearranged premium financing, we use one of the instruments, which is parametric insurance. So for the next few slides, we'll be discussing that. Please move on to the next slide. So Dr. Stewart, in his presentation, he mentioned on how we model different types of risk. He identified that different types of risk, the same way as Madagascar, they mentioned locusts, extreme heat, drought, and all that. But how do we move from that climate risk analytics all the way to a financial product? So the first step is to define the financial protection solution. And how do you do that? Is first by identifying the type of risk, which Madagascar has done in the first phase. So you identify these different types of risk, and the next step is to come up with risk mitigation, like a risk strategy. So there are three things you can do to the risk. You can retain it, you can reduce it or prevent it, and lastly, you can transfer it to the insurance market or capital market. And when it comes to CDRFI, when we're talking about CDRFI, we're talking about this risk that is transferred. And the risk that is transferred is the residual risk. After you have retained the risk which you can retain, after you have mitigated the risk you can mitigate, and you transfer this residual risk. So after identifying that, the next question is who is to be protected? Is it the government? Is it the vulnerable population? And even the vulnerable population is quite diverse. It can be school-going children. It can be the fishermen. It can be anyone. Is it the farmers? Is it the humanitarian organizations? All this is needed so that you ensure that you design the correct solutions. Lastly, you need to answer when should financing be released. Is it immediately after the disaster, or is it during recovery, as that would influence the type of solution you're designing and how the solution will be designed. So that's the first step. Let's move on to the next. The second step is now designing the solution. And for bias reason, I'm going to focus on parametric insurance as it's one of the core tools when it comes to CDRFI. It doesn't matter what type of parametric insurance, be it drought, tropical cyclone, or whatever. There are four key principles or key design choices that you have to consider. One, what's the index you're going to select? You have to ensure it mirrors the risk you're trying to transfer. For example, if it's tropical cyclone, you can look at wind speed, because when there's tropical cyclone, there are extreme winds. The other thing is to look at is, given that you're not going to trigger using by sending loss assessors to the ground, you're going to use this index to trigger. You have to ensure that you have mitigated or reduced basis risk, or rather you have validated the index, how it performs vis-a-vis to how the ground, there's the ground observation. So how do you do that? Let's use Southern Africa as an example. In 2023-2024 March, they experienced severe drought due to El Nino. The model that I've designed, if it's a drought index, I would expect to capture 2023-2024 season, a drought event. So that's how you validate the index. The second thing is to look at the data. Unlike indemnity insurance, your car insurance, and the rest, you don't send loss assessors to the ground. You use the index data as is to trigger. So it means even if you see there's no drought on the ground or tropical cyclone and it has stated that you have to trigger, you will now have to trigger. But so that means you have to be very careful the type of data you use. Garbage in data, garbage out index. So when you're looking at data, you have to ensure it's independent, it's objective, you're tested for accuracy, it's long enough to ensure you can price and not have crazy and crazy loadings, and it should be granular enough to match the type of insurance that you want to design. The third thing is the sum insured. Who or what's the financial objective for this? Is it for the government to respond to a natural disaster? Then you should ensure the coverage or the sum insured matches that. Is it for a farmer that wants to replace the inputs? Then you should ensure that it matches that. Lastly, you also need to understand what's the unit area of insurance. This is matched by the type of clients. For example, if it's a government level, they don't care about the small risks that are affecting farm level. They care about national systemic level. So that means they would want a unit area of insurance at national level, as opposed to a farmer who'd want to see how his farm has been affected by the different drought. So despite the type of parametric insurance, you have to look at these four things. I know there are many regulators in the webinar. So how can you assist when it comes to CDRFI? The first thing is easy approval pathways. All the products, given that new, they have to be customized. Regulators need to approve. Is there a way you can support in easing the approval process? Is there a way you can assist in terms of the local insurance or crowding in local insurance? Apart from that, how do you protect the consumers? How do you enhance uptake of parametric insurance, reviewing the products to ensure there's no mismatch when it comes to basis risk, reviewing the data, and also coming up with incentives like regulatory sandbox that can crowd in more partners into the CDRFI space. Please move on to the next slide. So now, the last step is where we have moved on from product design to coming up with an actual product and a premium. I'm an actuary, I won't get caught into the details, but I'll oversimplify it. We start with what Stuart mentioned, Dr. Stuart mentioned. You have to design, come up with a model, and then using that model, you end up with a financial module that gives you the modeled loss. But remember, as underwriters, ARC, be it Swiss Re, be it whoever, they have to load for capital. As the regulator mandates, they have to load for profit, because we'll either close shop and leave. We have to load for uncertainty. If the model is not clear, we have to have that loading. We have to load for cost. We have to pay commissions, fees, reinsurance, overhead. And that's when all of that is loaded, we end up with a premium. However, there are three competing demands. This is CDRFI. The client wants it affordable, so low premium. I, as the underwriter, want high premium so that it's sustainable. And we have donors and other people who want it socially acceptable because we are covering vulnerable population and the rest. So how do we ensure that we balance these competing demands? How do we ensure that CDRFI space is not just pilots and all that? The way we can do that is, for starters, having open source data, having modeling partners like Jeremy, the way they're doing to ensure that that cost is reduced and it's not transferred into the product. Also having regulator crowding in different partners, ensuring that local market can retain part of the risk, and also having better data that can be used to support the modeling. So with those three, you end up with a product, whichever product you're defining. Please move on to the next slide. So for the next two slides, I'll just give you a practical example, Madagascar and Malawi. So Madam Nirina mentioned that ARC work together to set up different products. So for a practical example is Cyclone. For the same risk, same climate risk analytics, they took up different products. For the lower layer, they had a reserve from a World Bank repair project, and also they purchased parametric insurance by government and also a humanitarian provider. By using this and designing different complementary solutions, solution after Tropical Cyclone Fitia and Gezani that happened in March. They were able to unlock $29 million, which helped the government respond to the tropical cyclone. Let's move on to the next slide. As for Malawi, also, they have been able to to layer different types of product or use different types of products for the objective of de-risking themselves. For example, in 2023-2024 season following the El Nino, they had 3 types of product: the government product, which was tracking the full season, an anticipatory product, which was tracking the sowing window, and a social protection product by World Bank, which was tracking the full season and the sowing window. And with that, they were able to unlock 18 million worth of payouts after the droughts that happened in March 2024. As you can see from these 2 case studies, is that with risk analytics, it can be used to design different types of products tailored to the different types of client and different types of purpose. So risk information is key, and it can be tailored. And for us to have a sustainable protection, we have to have disciplined design choices. And it's not just one party, it's across the full value chain. Thank you. Over to you.
Thank you, Jackie. Thank you so much for that presentation. And thank you. I think now we are getting the understanding of really what it means, to do climate risk analytics and to utilize this information to come up with solutions that fit the different contexts, the different countries, and so that those solutions are useful to the countries themselves. I think I will take one question here since we're running out of time, and it was the one that was shared earlier by Nino. Parametric products pay out automatically once a pre-agreed index threshold is crossed, rather than based on actual assessed damage. What happens when the payout doesn't match the real loss on the ground? I mean basis risk. Maybe Jacqueline, you can come in on this one.
I'll start, and I'm pretty sure Dr. Stewart will chime in. So the first thing is in terms of the product design. You cannot eliminate fully basis risk when it comes to parametric, but you can mitigate it. How do you do that? You look at the product design. So the selection of the index, does it mirror or correlate with the risk we're trying to de-risk? So that's the first thing. The second thing is validation. You have to validate various parameters and the output to ensure that it kind of mirrors what you're seeing on the ground. Lastly, when it comes to the insurance products, there are also mechanisms to reduce the risk. So for example, having an independent data certification agent, so whereby you can see the data we have used by may have had an error, and as a result triggering when it's not supposed, or there's causing this mismatch, and have backup data sets and all that. So it's in terms of product design that you can try to mitigate the basis risk. However, it can never be eliminated. I welcome Dr. Stewart to chime in.
Yeah, thank you. And I agree with what Jacqueline has said, and just to provide a little bit of detail around some of those design features. There's an increasing number of parametric solutions that provide a small payment when an event occurs, and then a hybrid approach where the parameter is then used to provide payment on top of that. So that's another way to ensure that there's some payment that's independent of that occurs as part of the contract. Another design approach is to use multiple parameters or multiple data sources and use an index approach that looks at how those parameters vary across an event footprint, to try to tie the local hazard parameters to the local effects, rather than using one single parameter. For example, a cyclone occurring on the coast of Madagascar. So you try to localize the parameters that you use. And so there are various design features and contract features that can be used to mitigate it. But as Jacqueline said, it's very difficult to reduce it entirely.
Okay. Well, thank you so much to the both of you. I think, Jackie, there's one more. I think it's a quick one. Does ARC have any country examples that target or focus on the livestock sector?
Thanks. I was typing my response. So we do have, at macro level, we have a drought index, which is based on vegetation index. So that's primarily tailored for livestock sector. However, at micro and meso level, we also do design or customize the indices depending on the type of livestock that we cover. So for example, part of the drive program, which is repair, which we support as well. Thanks.
Right. Thank you. I think now we have to move on to our final speaker, and we've just delved into risk information and how that can be translated into financial protection solutions. I think now we want to show, or the speaker wants to show us how the same insights can inform government decision making and national financial resilience. So it's my pleasure now to introduce Charles Chinkunta, Deputy Director at the Ministry of Finance and Economic Affairs in Malawi. So Charles will bring us the perspective that I think many of you have been waiting for. So how does risk analytics actually change what a government does? How does it shape fiscal planning, budget decisions, and the choice of financial protection? Welcome, Charles.
Thank you very much. I feel like much work for me has been done by the previous speakers because it centers around a similar objective. So I'll be just quick. I'm mindful of the time. Can you go to the next slide? Yeah, so I'm about to share Malawi's experiences in the CDRFI. Using risk analytics to inform decision making. I think we are pretty much in the same space with what Madagascar has shared, but just briefly to show where Malawi is, we are in the southeastern part of Africa, the red part there. So basically the key statistics are that we are 21.8 million people, and we are one of the countries that suffers mostly with the climate shocks. So we have droughts, we have floods, and of course the pandemics in both the crops and of course for the humans. Next. Yeah, so for us, what is the motivation for CDRFI? Simply because climate change is increasingly emerging, not only as an environmental and humanitarian crisis, but it is also a major source of macroeconomic instability and fiscal stress. So we have suffered both economic losses and the humanitarian costs. So the costs are very huge for a small economy like Malawi, and that is the motivation now to mitigate against these shocks. Next. Just to drive the point home, due to these climatic shocks that we have experienced over the last 5 years, we have seen that our economic growth has been greatly compromised. We are growing around 2.5%. The economy over the past 5 years instead of 6% that we should be growing. But also each successive climatic shock brings very huge economic costs on the government budget, such that we are increasingly spending more on recovery and bringing stress to the resource envelope that we have. So our fiscal deficit is always increasing, largely because of these shocks that we're experiencing. Next. So what have we done to at least mitigate against these things? First of all, we have come up with a disaster risk financing strategy, which is now a blueprint that would help the country to prioritize a transition towards a structured and layered risk disaster financing system. So we are aligned with a number of partners in this case, and our key priorities include the development of risk-layered financing instruments,
I think, Charles, you've gone on mute. If you can unmute yourself, I think you just gone on mute. Yes.
Okay, sorry. Yeah. So what have we done? We have developed a disaster risk financing strategy, which is a blueprint to prioritize financing towards disaster risks. So key priorities there include the development of risk-layered financing. This is now where we are talking about the budgetary reserves, contingency funds, and insurance mechanisms. The idea is to strengthen shock-responsive social protection and also to enhance coordination between humanitarian and the government systems in response to these disasters. And the strategy also helps to improve speed and the predictability in that space. Next. Yeah, so what is our experience with the climate risk analytics? Our typical case is the ARC, the African Risk Capacity and Drought Insurance. So I think much of it has already been talked about, but I'll just talk much on the setup that we have. So we have a multidisciplinary technical working group team, which comprises of government staff, civil society organizations, development partners, and of course the academics. So these form part of the technical working group that now works on the validating the parameter index that is developed in order to trigger the payouts that we have. So we have a drought. The major one has been the drought insurance from ARC. So we need to come up with the trigger thresholds jointly with ARC and us. So the analytics, the hazard is defined. We come up with define the data sources, and then we define the model together, and then we come up with the trigger thresholds together. So this is an index. So the validation is done by the local team. And then once that is done, it is escalated to the authorities for approval, and then a policy is bought by the government. So that's basically the process that goes on. Next. Yeah, so this is what I've just described. So it's a country-owned process where risk assessment is done, the data collection is done, and then a policy development and the agreements are done on the trigger thresholds. We agree on the hazard levels. And I think what we have done so far is what this team is doing at this stage is to relate that the parameter is speaking to the situation on the ground. So the validation process, that is very, very key. We have learned a lot of lessons from that. Next. So with this collaboration that we've had with ARC, briefly, what I can say is it enables early warning response, and it also helps into contingency planning. And as I've already said, it's an index-based insurance, and we have a transparent funding mechanisms, and it also comes with the capacity building. So it's both ARC and ourselves building the capacity in climate risk analytics, which we have done together, and we have come up with a system that is well structured and sustainable. Next. So based on what I've just said, the build up to the process that I've just said, so this is what we have received so far. So this slide is just trying to show the payouts that the country has received throughout this process. So it's something that is working from our side. Of course, not every policy, not every policy, it triggers in that case, but we have had a good experience in terms of adapting the processes, the climate risk analytics, and of course the financing instruments that come with it. So pretty much on the right path. As you can see, the analog years that I've given, the amounts, and of course the payouts associated with the premiums. Next. Yeah, so what are the key outcomes so far? One is the issue of timely payouts for rapid response. So the process enables quick deployment because I've already indicated that this is a multi-sectoral team. So we have all the partners in the technical working group. So each partner has a role to play and the transition is very smooth. So one thing that we are seeing is the timely payouts for rapid response. And also in the process, we have built capacity for both institutions and of course the individuals. And there's also cost efficiency and partnership in terms of.
Charles, you're on mute again. Sorry.
Oh, I don't know what is happening.
All right,
Okay.
just go on.
Yeah. So cost efficiency and partnership models, but we have also learned issues to do with targeting because the triggering a payout is one thing, but now how do you translate the payout to the actual beneficiary, the vulnerable population? So throughout the process that we have developed, now we have perfected, we are more or less like moving towards that, dream of targeting perfectly, so that we remove the inefficiencies that come up with the distribution or the money out processes. Next. Yeah, so every process has got its own challenges. We can't say everything is rosy. The main issue or the main issues, one, we're talking about the limited level of risk coverage considering the climate unpredictability. So we are only covering a small part of the overall basket of risks that we have, the floods, the drought, the pandemics, but it has got something to do with our resource envelope. So it's the limited fiscal space that now narrows us to a small area of intervention. And also the issue of limited technical capacities, we are still building our skills. The issue of data to verify and validate. And this is where now we are having to bring in the support from Global Shield and the Global Risk Modeling Alliance, and also implementation capacities in some cases where a robust and harmonized targeting methodology, so that we need to reduce exclusion. So the issue of target improving inclusion error, we need to reduce that one when we have the payout, and then we have to go to the actual beneficiaries. And also limited capacity of community structures to facilitate targeting at beneficiary selection level and verification. So these are some of the challenges associated with the processes. Next. Yeah, that's all what I have to share. Thank you.
Thank you very much, Charles, for sharing Malawi's experience and also just for demonstrating how climate risk analytics is important in terms of making decisions. And I think it's impressive to see the outcomes that you've already shared, but also to just acknowledge and recognize that there are still challenges that needs to be worked on and needs to be taken care of. And so thank you so much for your presentation. On that note, I know we have a lot of questions and we are a little bit pressed for time. So what I'll do, I will pick some of the questions from the chat, at least if you give me 5 to 10 minutes of your time so that we can answer a few questions. And please also feel free to raise your hand if you want to ask your question directly to us. But in the meantime, I would, I don't know, Andrea, if you could guide me to the first question if you've missed. I know there's a question by Sinridi on in the works,
yes.
which
I was because there's a couple of questions. I don't know if we want to start with one directly at Charles. As kind of follow for your presentation. Here, Gift Fisher Malaya asked, he just wanted to find out a bit more about the transparent fund mechanism and how does it work in Malawi. I think we could, that's if you could provide some input, and then we have some more questions for the panel as well.
Okay, you say the transfer mechanism?
The transparent fund mechanism, yes.
Transparent.
Yeah.
Okay, yeah. So it's because it's a multi-sectoral, it's not that it's like one agency handling everything, but it moves from one agency to another to the other, and all the partners are in a team in that technical working group. So we have the Department of Disaster Management Affairs, which is the main lead there, but we also have Minister of Finance in there, we have Minister of Agriculture, we have Gender and Social Welfare. And then we also have this representation from the civil society organizations. So everyone brings in different expertise in the setup, and then roles are adequately shared or appropriately rationed between the different expertise that we have. So the whole process is transparent in the fact that we have a multi-sectoral representation, everyone with their own responsibilities along the chain.
Great. Thanks, Charles.
Thank you.
Maybe, Andrea, we could move on to the second question if that is adequately answered. Andrea.
Apologies. Yes, apologies. I couldn't unmute myself quickly enough. Yes, we do have some questions. I think Stuart has been doing a really good job at answering the questions on the chat as well. So I'll try not to repeat any of the ones that he has responded to already. But we did have a question from Hans to learn on the Madagascar and GRMA collaboration. And is specifically asking on how would you gauge the readiness of insurance providers to rely on the Madagascar own risk model for parametric insurance products. This is going back to the case in Madagascar.
Yes. If Madagascar would like to take that, or Stuart, if you'd like to take that.
I'll defer to Nerina.
Yes, Madam Nerina.
Can you repeat again the question, please?
Of course. How would you gauge the readiness of insurance providers to rely on the Madagascar own risk model for parametric insurance products, as opposed to regionally or globally recognized risk models and analytics?
Sorry, if you don't mind, we will change. We will use the interpretation, and if we can have the French version of the question, please, if you don't mind.
Yes, I think Maureen, you can take that up. But in the meantime, as we wait for Madagascar to process that question, maybe we could tackle another one and then come back to it so that we can save on time. Yes.
Yes. Apologies. This is a question for Jacqueline. I think, do you have experience with modeling and setting up dual triggers for parametric insurance, where one trigger is set at a lower threshold before disaster occurs to help mitigate its impact? This was by Lixia Yang.
Yes, thanks. So in terms of product design, we look at what the client needs. So we have practical example whereby we trigger a smaller portion. For example, the Malawi social protection. The early window was a different index, but triggering a smaller payout vis-a-vis to a full window product. So we tailor this depending on the needs on the ground. And also we can combine different indices to make it an hybrid, not just how it triggers. Thanks.
Great. Thanks, Jackie. I think Madam Nerina, if you want to come in on the previous question, or also there's an opportunity to also, yeah, okay, go ahead.
Excuse me, Monica, we are now in French with the French interpretation. If we can have again the question in French, please, so that we can understand well what is asked. Thank you.
Yes, we've put it in the chat in French, but Maureen, would you be able to just read the question out loud in French for Madagascar? If you could change the channel, if not possible. Oh, Okay, just to save on time, I think let's have it, we have it in the chat in French, but we can also respond to it in the chat. But maybe let's take a couple more questions and then we come back to that at the end, if that is okay, Madam Nerina, because of time. Yeah, and Andrea.
Yeah, I think we do have one more question, and just to make sure I do not in case Stuart already answered it, but I don't think he has. There was a question specifically on if it would be possible to elaborate on how the risk models and exposure database are linked to ARC's triggers, any data or institutional constraints so far based on the GRMA support that has enabled multi-hazard risks polling in the case of Madagascar.
Yeah, in the GRMA project and work program, I think we've been trying to develop an exposure database that could be used for risk assessment generally, but it hasn't been so far tied to ARC products and things. But it's designed to underpin risk assessment for disaster risk management and risk financing applications variously. Same with the hazard assessment in Madagascar. There's been 8 hazards modeled to understand the risk profile, with several of those using probabilistic risk estimates for to be more useful for risk financing. But some of the risk profiling has been to understand the distribution of risk and how that changes potentially in a future climate. But the work was not specifically tied to ARC products, though some of those exposure information can be used by ARC and by others because they're publicly available and can be used in different applications.
Great. Thanks, Stuart. Madam Nerine, would you like to come in now? I think that's our last question. And yeah.
Yes.
Go ahead.
Yes, Monica, thank you. So we would like to say that for Madagascar, within the framework of sovereign insurance mechanism, we use risk models that are developed and recognized at the regional level by the African Risk Capacity. And these models are based on robust scientific methodologies, and they have undergone rigorous validation, calibration, and verification processes to ensure their reliability and credibility among insurers and reinsurers.
Great. Thank you. I hope that is satisfactory.
Yes.
But if you have any more questions, yeah, thank you, Madam Nerina. You could still please share your questions with us. We can follow up with them if you have any more questions. But in the meantime, I think we are coming up to time, and I think we won't be able to get to any more questions unless there's one burning question which you can take up. If somebody wants to intervene. But if not, I would really like to thank our 4 speakers warmly, Dr. Stuart Fraser, Madam Bako Nerina Rabe for HITRA, Mrs. Jacqueline Mudengi, and Mr. Charles Tinkunta. Thank you for your generosity and also for your candor today and for sharing all the knowledge and information and experiences with us. And I would just try to draw the threads together and say that I think throughout today's discussion, the one message that kept on coming up is that climate risk analytics does not build resilience on its own, but the value really lies in enabling better decisions. And so as Dr. Stuart showed us, climate risk analytics provides the evidence we need to understand and quantify risks. And then Madame Nerine demonstrated how countries strengthen the national capabilities to generate this evidence. And Jacqueline illustrated how we could use this risk information, to develop financial protection solutions. And also Charles just did show us how insights ultimately inform government decisions on planning, public finance, and resilience. And so this is our running thread throughout this entire webinar, from analytics to decisions and to financial protection, and finally to impact. And so where do we go next from here? So first, we have the foundational learning. As I said before, today's session was just complementary to the Global Shield foundational learning we have, the self-paced resources available. So if you left this session wanting the fundamentals, then I think I would advise you to go there and have a look at these resources and just delve into them and get a better understanding of the topic today. And as I said, this is our first webinar, but we'll have 3 more coming up. On 29th September, we'll have one from risk to response, designing CDRFI solutions and instruments. So we go really deep into the instruments and risk clearing. And then on December and on 2nd March, we get into more of the inclusivity of these instruments. So registration will be open ahead of each session, and everybody here will definitely get notified. And finally, as I know we had comments in the chat, we will be sharing the recording and the slides will also be shared with everybody who registered for this session. And one last thing, and this really matters to us, we'd like you to take 2 minutes to complete our survey. My colleagues, the QR code is on the screen. My colleagues will also share the link in the chat. And once we share with you the slides and the recording, we'll also share with you the link to the survey so that you can help us really genuinely shape the next design of the next 3 webinars. So once again, thank you to Katia, to Dr. Stewart, to Madam Nirina, to Jacqueline, Charles, and all of you for joining us, for your thoughtful questions, and also for your engagement towards today's discussion. We hope to welcome you back on 29th September for the next webinar on designing solutions. And until then, I'd like to say thank you very much, take care, and goodbye. Thank you.